The stimulus and inflation. Let's talk about it. The Fed's quest for higher inflation. What could go wrong? October 9th by Stefan Gleason. The Federal Reserve is warning investors in no uncertain terms that higher rates of inflation are coming, yet markets for the most part have disregarded that warning. Bond yields, for example, will remain below 2% across the entire duration range. Stock market valuations continue to reflect a sanguine outlook for inflation, and crude oil futures suggest limited upside pressure on prices. It seems the Fed has a credibility problem. In August, Fed Chairman Jerome Powell announced that the central bank would begin targeting an inflation average of 2%. By the Fed's measures, inflation has begun running below 2% in recent years. So getting to a 2% average in the years ahead will require above 2% inflation for a significant period. In September, St. Louis Fed President James Bullard doubled down on higher inflation. He said the combination of loose credit, huge government deficits, and supply bottlenecks caused by coronavirus lockdowns could cause an unexpected surge in price levels. Billionaire hedge fund manager Stanley Druckenmiller is worried that the U.S. dollar will lose purchasing power much more rapidly than the 2% average the Fed is currently telegraphing. Druckenmiller recently said he sees inflation rates likely rising to 5%, perhaps even 10%. The Fed's credibility problem could quickly morph from one of not being taken seriously on the risks of higher inflation to one of not being trusted to keep it contained. Perhaps gold investors know something that bondholders and most Wall Street analysts don't. The gold market surged to an all-time high in August before selling off in September. The major bull market appears to be intact, however, which means that the next rally could lead to higher highs still. If gold is a leading indicator of rising inflation, falling confidence in the value and credibility of the U.S. dollar, then investors should expect other assets to follow gold's lead. Instead of enjoying endlessly rising equity values, they may suffer from relentlessly rising food, fuel, healthcare, and other costs of living. The upshot is that investors can own hard assets that may be set to follow gold to all-time new highs of their own in the months and years ahead. Silver and platinum, for example, remain relatively cheap. They could each double in value from their current levels in terms of dollars and still have room to run before making nominal highs, let alone real inflation-adjusted highs. Gold and silver's response to inflation should be spectacular. Inflation expectations fundamentally shift from the doubt that the Fed will ever achieve its 2% average to fear that it might overshoot, then precious metals could see a spectacular rise. They won't merely go up a few percent to reflect a gradual rise in inflation, they'll go up multiples to reflect surging investor demand for safe havens. We saw a preview of that phenomenon in the first half of the year in the midst of coronavirus lockdowns. Demand for bullion went bonkers, sending spot prices and coin premiums sharply higher in a very short amount of time. A new inflation upcycle can be expected to last much longer and produce much more dramatic results on the charts for metals. The last true mania phase in gold and silver occurred in the inflationary late 70s. History doesn't repeat exactly, of course, but it does give us a rough guide for what could unfold for investors facing a similar environment. Severe real losses on cash savings, bonds, and other fixed income instruments. A sluggish stock market that fails to keep up with inflation except for a few select sectors. A spectacular rise and eventual fall in precious metal prices. Yes, manias do ultimately end badly, but in the case of hard assets like silver, which have been depressed for years, they are far closer to a major bottom than to a mania peak. As long as the Fed remains committed to depreciating the currency at a more rapid pace and punishing savers with negative real interest rates, which it has vowed to keep its funds rate near zero through 2023, the major trend for precious metals should remain higher. Okay, if we go back up to the top here, this is all covering inflation, talking about inflation. Yet markets, for the most part, have disregarded this warning. And if we go over here, there's a perfect example of it. It's a more mainstream news article. Here's why economists don't expect trillions of dollars in economic stimulus to create inflation. I'm not going to read all this, but You go to Google, search for stimulus and inflation. You'll find article after article with this sentiment: stimulus equals inflation. Why it may be different this time. And it's all just putting perfume on a big, heaping, stinking pile of you know what. Putting lipstick on a pig. I mean, the more money you print, the less value it has. What happens when we print so much, it's worth so little that we lose world reserve currency status on the dollar? I mean, we're sitting at $24.40 spot price on silver right now. You know, what happens when the dollar loses so much value that we see metals rise and silver sitting at $100 an ounce? You know, that sounds great. You know, that sounds awesome. A lot of us been stacking for years. That's what we want. I don't necessarily see that as a good thing. I mean, imagine we have $100 an ounce silver. What do you think a pound of ground beef will cost? $50? A pack of toilet paper, 30, 40, $50? The more we print, the more it becomes worthless. And whoever wins this presidential election, I see more of the same. I see more stimulus coming, more money printing, more quantitative easing. Look, the more stimulus we do, it's good for the people on the surface. It's good for businesses on the surface. It'll boost the stock market for a while, but it'll create a phony recovery. It's all short term. The people affected, you know, they get comfortable with the handouts. They get a little lazy. We all need to realize that this stimulus is a short-term Band-Aid. Creates more debt, hurts the economy in the long run. I mean, it's, again, in the supermarket, that's where the Fed policy is going to be reflected the most. Grocery stores and cost of everyday items. Printing money is not the long-term solution. I don't know what is, but printing money, it's a Band-Aid for a bleeding out budget deficit, a bleeding out trade deficit. The government's spending more than ever, printing more money than ever. The more you print, the more value it loses. I mean, you can't get away from that. That's why I stack gold and silver. It's a hedge against inflation. And in my opinion, it's needed to keep your savings from becoming worthless. We might not all get rich. It might not be the best investment, but it's the safest. And that's my stance on that. Let me know what you guys think in the comments. Don't forget to like and subscribe.